What's up, everybody? So this is my son, Keanu, and I'm going to show you how we set up his very first infinite banking policy to make sure that he's taken care of, his kids are taken care of, and his kids' kids are taken care of for generations to come. This is all about legacy, so it doesn't have to be big to start, but you got to start somewhere. So we'll show you exactly how we did that. And you got anything to say, buddy? Thanks, Dad? Anything like that? I'm sure you'll say thanks later on once you realize what this is doing for you. So let's go ahead and get into it, and I'll break everything down for you. If you have any questions, please don't hesitate to ask. And yeah, enjoy. All right, guys. So let's go ahead and take a look at my son's policy here. So again, whenever it comes to this type of thing, if you're going to be working with somebody, you want them to be as transparent as possible with you. And so I never have any issues showing people my policies, my family's policies, anything like that. Now, understand that this is an illustration. So as soon as we start banking with this policy, which we already have, this illustration is going to be out of date. It's going to be basically useless because they're just giving you a first look at what this could be or will be if you do nothing with it. We're going to teach you to bank with your policies. So whether you're banking with your children's policies or not, I kind of like to think of it as one big pool of money. So money's flowing in and out of my policies, my wife's policy, my son's policy, all while we're making money for those policies. So understand that this is just an illustration. Your illustration will be the same thing as far as once you start using it, it'll be out of date. What you can do is always request new updated illustrations as time goes on so you can see how things are progressing within your policy. Like I said, this is my son's policy, Keanu King. The initial death benefit, which is really a secondary benefit, is $225,000. We've got $3,000 a year that we're putting into this in annual premium. We pay annually for the policy. You do not have to pay annually, but is the most effective way to pay for your policy. Then this is a policy where he is allowed to pay up to age 65. So you see, I say allowed to pay. The older he gets, the better this is going to get. The more he's going to want to put into it, the longer he's going to want to pay. So it's not, oh, I have to pay until 65. It's, oh, I get to pay until 65. If you created yourself a money printing machine, wouldn't you want to be able to put money into it for as long as you possibly can? The answer to that question is obviously yes. So this one specifically will allow him to do that up until age 65. Age here you can see listed as 0. It's because he's under 1 year old. So because he's 10 months, it's going to be listed as 0. And then this is a non-MEC policy, meaning this illustration, based off this illustration, policy will not be taxed. It will not hit the MEC status, so shouldn't have any issues with that. And then every child, because they can't get a better rating class up until they're 18 years old, gets just a standard non-tobacco rating. So not a big deal. Again, when they turn of age, you can go and get that. And if they're preferred at that time, which I imagine they would be, you can get a slightly better rating class and get a little better deal on the policy overall. So specially designed participating whole life policies are made up of two key portions. You have the base of the policy, and you have the accelerated paid up additions rider, the PUA. So with the base policy on our son's policy, we split it up as a 60-40 blend. 40% goes to the base and 60% goes to the paid up additions. Now you could do a bunch of different things here, but with kids policies, I think that 50-50 or 55-45, 60-40, right in there is going to be the best blend for children's policies. You could even go more base. And when you understand how these policies work, you'll get that more base means more longevity. And again, I don't want to get into all of the details of that right now, but base is extremely important. You should know that by reading Nelson Nash's book. So extremely important stuff there. But this policy is constructed basically 60-40. So that means 40% again is going to the base, which would in this case be $206,000. That portion, $1,233.94, is purchasing out of the $225,000. So that means a small amount is being purchased by your PUA, your paid up additions. But if you broke down the math, this is basically 40% of 3,000, and this is 60% of 3,000. So the PUA, again, if you don't already know what that is, the paid up additions, this is going to be the money that you have liquid access to. We like to say right away or within the first 30 days. I had access to my policies within the first week, the cash in there. So again, we just like to say within the first 30 days. And you're going to have access to 90+% of this cash, usually up to about 94% of the cash that you put into the PUA. They usually hold on to about 6%. That's paying for some of that extra insurance there and a few other little tiny things that they need to hold on to for safety and security reasons. So oftentimes people ask, hey, what about fees? What about expenses? What about all of these other things? And if you see right here, we're on the itemized premium breakdown. And if you add these two numbers up, you'll notice that this is $3,000. So all of the money that you're spending, that we're spending in this case, is accounted for right here, $3,000. So I don't need to know where anything else is going. What about this money? What about that money? No, all of my money is accounted for, which I like. Extremely clear, very transparent. One thing I want to point out before we get on to the actual illustration portion is you guys need to differentiate this from everything else. Oftentimes people come in here and when they see the numbers, they see the illustration, they start to compare it in their minds to other things that they're familiar with, which I totally get. That's very natural of the brain, the mind to do, because you want to relate it to things so you can understand it better. But what you're missing is you're relating it to the wrong things. This is not an investment. So if you're going to look at these numbers and you're going to be talking about returns and, all of that type of stuff, you're talking about investments. If you're like, well, I could go get 10, 12, 15% out in the market. I mean, come on, let's be real. Good luck with that. Maybe 1 year, but not consistently. If you're comparing this to that, you're comparing apples to oranges. You're comparing water and oil. They're not at all similar. This is a savings vehicle. So if we're going to compare it to anything, what we want to compare it to, what it's most like, is your savings account that you opened up with your bank down the street from your home. So when looking at this, when looking at these numbers, try not to think, oh, well, I can go do this investment and get much better returns, do this, that, and the other thing. No, that's not the point here. The point here is being able to control your money, to have liquidity, for it not to be locked up, for you to be able to spend it and save it at the same time. A lot of things that your savings account can't do for you, but it's most like a savings account if you have to, compare it to something. So understand that. Understand that we take our money from our policies and go do all the same things that you want to do with your money. All of those returns that you're talking about getting, we can still do that just like you do. You take your money from your bank account, or maybe it doesn't even hit your bank account because you have something set up, qualified plan through your work. So they just take it right there. You never even see it in your account. But either way, if you're investing in mutual funds, whatever it may be, you're taking the money from your account and you're sending it off to go do those things. Just imagine this being your account. But as you take that money out of your policy and you go and put it in these other places where you can go and make higher returns, it acts like it's still in there for you, earning that continuous compounding interest. So something very important to remember. Now, let's go ahead and take a look at the illustration. I'll kind of break down what this all looks like, for, again, my 10-month-old child. So this is his very first policy. This is one of many that he will have throughout his life, and he will quickly outgrow this policy as far as the amount of money that we're going to be putting into it. So we will be starting another one at some point in the near future. But I'll explain all of this to you here. First of all, number one, before we get to the actual illustration portion, we do not present people with illustrations until they go through the process of getting approved. Because we could sit here, we could go back and forth, we could create illustrations for people, we could do, look at numbers, we can do all this stuff. And if that's what you're focused on, then you're missing it. Because again, the illustration really means nothing. As soon as we start banking with this thing, it's going to be completely irrelevant. So we don't show illustrations to people until they've gone through the underwriting process. They're qualified, they're cleared to get their policy. And then we say, hey, this is what this looks like. These are the numbers, blah, 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 blah. Let's go ahead and blow this thing out of the water. So understand that. Now, when we're looking at the illustration, what you want to focus on is there's two sides to this. You have the guarantee side and the non-guaranteed side. The guarantee side is what the company says you're going to get no matter what. Guaranteed. That's why it says guaranteed. So again, with participating whole life policies, there are guarantees, unlike other policies like universal life, index universal life policies. There are guarantees here. And the company says, hey, the worst your policy is going to do, we can guarantee you the worst it's going to do is this guaranteed column. That's if you're not getting any dividends or anything like that. If you're not banking with your policy, putting any more money into your policy, if you're just doing what is on this paper, this is what's going to happen. We guarantee it. Cool. Great. I like that. I like the guarantee side of things. I like to know what's going to happen, worst case scenario. On the other side, you have non-guarantees. And on the non-guaranteed side, that's including their projected dividends, which I think they always kind of project dividends lower than what's expected because, let's be honest, who likes to overpromise and underdeliver? Everybody wants to underpromise and overdeliver. And so that's, I kind of think, what's happening here with the dividends. And the company, One America, this is the company that the policy is with, has been around for a long time. They have not missed a dividend to their policyholders, us, in over 146 years. That's through the wars, Great Depression, through all these crazy presidential elections that we've had, all of this stuff. They've made it through it all, paying out dividends to their policyholders. So I can't sit here and tell you that dividends are guaranteed for your policy, but I also can't sit here and tell you that the chances that you won't be getting one are high at all. I like to look at history. History states that they've done this 146 years in a row, and they actually just put out a statement for this year saying that dividends have gone up. Things are trending in a great direction. So fantastic. Good for us. So the total cash net value right here is your amount plus the dividend. And that just increases every year as time goes on. So you can look at either side when you're looking at this, guaranteed, non-guaranteed side. But for this example, I'm just going to kind of look at the guaranteed side when I point a few things out here. So remember, we're putting in, for my son, $3,000 a year annually. We do it all at once. Automatically, we have access to approximately $1,700. So what that means is, remember, we split this 60-40. So this is the 60%, the paid up additions. And you remember what that number was? It was like 1766 and some change. So they're telling us that you're going to have access to around $1,700, which is 90+% of the money that you put in. Again, pretty awesome. That's why the infinite banking portion of this is really cool, because we can set it to the amount of money that you need to be doing the things that you need to do, make sure that the base is taken care of, and boom, If I go and take this 1,700 out for my son to do some things, to make some investments for him, whatever it may be, we still got 3,000 in this bad boy cooking, still earning interest, still making that dividend year after year after year, whether I pay this back or not. But of course, I'm going to play good banker. I'm going to make sure I pay this back with interest, because when I take a loan from my policy, my son's policy, my wife's policy, doesn't really matter. When we take a loan and we repay that loan back, we repay that loan with interest, just like we would if we were to take a loan from another institution, another financial institution, another third-party lender. There's no way somebody's going to lend me money for free, maybe for a short period of time. Maybe there's a zero interest window or something like that, but they're going to hit me with it later on, and I'm going to make that up. So instead of paying a third party for that money, I'm going to pay myself. I'm going to pay the insurance company. People are often thinking, well, I don't want to pay to use my own money. You got to think about it like this. You're a business owner in this situation. The business that you started was a banking business. You opened up your own branch of your bank. Now, what the insurance company is saying is, hey, we will give you our money, some of our money from our general fund that you can go use, and we're going to charge you 5% on that money. Now, when you pay interest, that 5% on the money that you're loaning out of the policy, and you pay that back, you know what that's doing? Because you're a mutual owner of the company, that's helping the company grow, which is increasing your dividend. So depending on how you want to look at it, I'm a glass half full type of guy. I know that if I'm taking loans and my company is charging me to take those loans and I'm paying those loans back, that I'm only helping my business grow, which is getting me a bigger dividend. Again, totally up to you, but that's the way that I think about it. So I'm just helping myself make more money by helping the company make more money. Now, when I take that money out, again, I have the ability to pay it back or not pay it back. And if I don't pay it back, we all know that if something happens to the insured of the policy and they pass away, well, the insurance company is going to give you whatever that death benefit amount is, less than the amount that you had out on the loan. So with this policy here, if we go out and we take out $1,700 out of this, total net cash value that we have, and we pay it back to ourselves, we as good bankers are going to pay ourselves back with interest. You can decide the terms. Oftentimes we can help you with that, but let's say that you're getting a car or something like that, and it's 6-7% that they would normally be charging you. So maybe you charge yourself 10%. So you repay yourself interest of 10%. And when you do that, that's going to go into your paid up additions. Really easy to walk through this process and make that extra payment. I do it all the time. And that payment is going to do three things. So instead of paying that interest to a third party and losing those dollars forever, along with the money that you had already given them for the original purchase, that money goes back into your system so you can use it right away again. And that purchases you more death benefit, more cash value, and a bigger dividend, essentially for the rest of your policy's life. So there's so many things this does for you just by utilizing the policy and playing honest banker that, again, these numbers that you see, they're not supposed to be impressive. Nobody says, hey, come take a look at this savings account we opened for you down at your local bank. It's going to make you filthy rich. You're going to be blown away by the numbers. No, that's not how it works. But what will happen is as we bank with these things, these numbers will increase and they'll increase and they'll increase because rule states that on the guaranteed side, these two numbers, the death benefit and the cash value, have to meet by age 121. So if we're making purchases with our son's policy, the cash value, if we're doing investments for him and doing all of this stuff, and we're paying ourselves back plus interest, and it's increasing the death benefit, then what automatically happens? If that increases the death benefit, then by default, the cash value has to increase, because we know no matter what by age 121 that the cash value and the death benefit have to equal each other. So as I'm making these extra interest payments back to my own policy to increase my death benefit, cash value, and dividends, I know that, again, by default, I'm just forcing my cash value to climb even faster than it normally would. So you can see as the policy goes on, year 2, we put in another $3,000. We've got, extra cash, $4,183 that we can use. And that just keeps going. It gets bigger and bigger and bigger. Now, one thing people often like to look at is what we call the efficiency zone. And so the efficiency zone is basically when I'm putting in a certain amount, so whatever that amount is for you, your annual premium, in this case it's $3,000. I put in $3,000 and it grows by more than $3,000. So I put in $3,000 and that year they say, hey, you know what, Shawn? Your policy cash value, we know you just put in $3,000, but you now have an additional $3,077, which means my money is now in the black. It is now making me money every time I put money into this policy. So that happens for this policy, for my son's policy, with zero banking involved between year 6 and 7. So we put in $3,000 year 6, and boom, we've got $3,077 that we're able to use. So what's really cool about this is you're like, all right, year 6, year 7, whatever year that is, you're like, that's cool. That doesn't sound too bad, especially for a kid. He's got time to wait. But what if we're talking about my policy, and what if I need that to happen a little bit faster? What if I want to be getting that cash on cash return even faster? Well, you know what's going to help with that? If you bank with your policy. The quicker and the more frequently you bank with this thing, the more interest that you're paying yourself back, all of these things, the quicker that you're going to get to that point where you're putting in $3,000, $5,000, $10,000, whatever your premium is, and you're seeing your policy spit you back out cash available of that number and greater. Because once it starts, it's never going to stop. So if it was year 6 or year 7 that this happened, it's going to get bigger and bigger than that every single year for the rest of his life. Now, in this example, I have this illustrated showing him stopping paying $3,000 after 10 years and dropping it down just to the base, that $1,233.94. But in no way is he going to do that. He's going to continue to put in as much as they allow him to put in, because would you rather put in 1,000 and it return you 120%, or would you rather put in 3,000 and return you 120%? Well, I want to put in the bigger number because I know it's going to give me more money. So nobody says, you know what, if I put this $5 into this ATM, it's going to return me $10. Cool. But if I put in a 50 and it returns me 100, well, I'd much rather put in a 50 than a 5. That's the same thing here. You're going to want to put in more money. And that's why I said with the premium paid to age 65, he gets to pay into this thing until he's 65 years old. And that's just this policy alone. So again, this is pretty incredible. It gives you the death benefit, which is great. Again, nobody ever really focuses on that with infinite banking, but it's a huge benefit because things do happen. And, we know death benefit is extremely important. And really, to understand this, guys, cash value is just the equity within your death benefit. It's the access to the liquid cash that you have right now of your death benefit. We like to compare it to the equity that you have in your home. I can go grab that money through a HELOC or something else like that, and I can use that. Now, of course, there's rules on paying that back, and, there's requirements and time, you have to do it. Unlike this, where you don't, there's no timeline. Nobody's going to call you up and say, hey, we need that $1,700 back, Mr. King. Nope. That's not how this works. It's your bank. You're running the show here. But that's one of the reasons why we like this stuff so much. The flexibility, the convenience, the liquidity, the consistent, continuous compounding interest that's happening even though we're taking money out of the policy and making more money with it other places. So again, these numbers are not going to blow you out of the water. They're not supposed to blow you out of the water. But if we bank with this thing, if we teach our son how to utilize this thing correctly, just this policy alone, one of his very many policies that he's going to have, we can double, triple, quadruple these numbers as time goes. And this thing is just going to be, it's going to be pretty freaking impressive. So we're talking about, by the time he gets to 40, he has $300,000, $400,000, $500,000 in cash because he was banking with his policy that entire time. Now, again, as you get to the point where your policy can no longer take any more cash, or you have extra cash on hand outside of what they allow you to put in for the base, because the base is what you can put in for the rest of your life. PUA, at some point in time, they'll say, hey, we can't take any more PUA, sir. We just got to do base. That's why you don't want to have a very tiny base and a huge PUA, because, later when my policy is super efficient and making me all sorts of returns as far as cash on cash goes, 100%, 200%, 300% returns, we already talked about this. I want to be able to put in the biggest number possible, not some tiny little number, not 10%, not 15%. I want to be able to put in 40, 50% of what I started with. So when that time happens and he has extra cash, which again, this will happen way before he's this age, we'll start him another branch of his bank, and then we'll start him another branch and another branch. And that's just how it goes. That's why I have multiple policies, and that's why I will be getting more policies, because as you start to make more money, your policy that you originally started with can only hold so much. So you expand out, the branch grows, everything gets bigger and bigger until it's time for your next one, or until you can't personally get any more policies or life insurance on yourself. And so you get them on other loved ones, other family members, other, people in your life that you have some sort of influence over. So yeah, guys, that's really it. That's as simple as it is. This thing is just going to get bigger and more efficient as time goes on. At 65, you can see right here, he has to stop putting in the money. They force him to stop putting in the money. And let's just take a look again with zero banking involved, literally just doing what he's doing. At this point in time, at 65 years old, if he put in $1,200, we're going to call it $1,234. If he put in $1,234, his policy grew by $19,000. I don't know about you guys, but you can go ahead and do the math. You can figure out exactly what that is. I could do the math for you, but I didn't do it beforehand, so I don't have time to. I'll throw it on here. I'll let you know what the number is, and I'll toss it right around here. But as far as cash on cash return, meaning I put this much in and it gave me this much in return. So you can build yourself a money printing machine. It's very real. It's very possible. You just have to have the knowledge on how to do it, how to set it up correctly. And that's exactly what we're here for. So if you want to start one of these for yourself, if you want to start one of these for your children, if you want to start one of these on your parents so that they can utilize it, and then when they pass away, they're going to be the ones leaving you the death benefit, so you can have a windfall of cash and fill up your policies, fill up your kids' policies, all of that type of stuff like I'm doing with my parents and my family, then reach out. Let's chat. Be happy to help you, be happy to educate you, be happy to get you all the information that you need so that you can make an educated decision. At the end of the day, you guys, the information is always free. We always just want to help you get educated so you understand what's going on. But understand that the knowledge is priceless. Once you see this, you can't unsee it. Once you realize what's going on, once you understand this tool, this asset to building wealth, you realize that this is not an either or asset. This is the and asset. This is the ideal asset. I can do this and do every other thing that I was already going to do. And that's what makes this so cool. That's what gives yourself, your family, your kids opportunity, because it's all about liquidity. It's all about cash flow. And that's what we want to help you create when the time comes and you're ready to use your money. We don't want it to be locked up in these qualified plans where you can't get to it, where opportunity presents itself and you're going to get penalized if you try and access it. We want you to be able to have liquidity in your life, to be able to get access to your money, to go and use it while it's still working for you in the background. This is exactly how we do it. This is exactly how the wealthy do it. And we want to make sure that you understand how this can be done and utilized in your own life to build yourself a legacy. So, look forward to chatting with you soon. Head down to the description, book your free cash consultation. Make sure you watch our overview, which I will pin here at the end to get a full understanding of infinite banking and how the process works. And again, we look forward to connecting. All right, guys. Well, I hope that brought some clarity to you and gave you some information on how these policies work, what the breakdown looks like, and hopefully hear from you soon so we can help you start your own for your kids. If you have any questions, please don't hesitate to ask. Like I always say, the information is free, but the knowledge is priceless. Look forward to talking to you soon.